What's going on, YouTube? In this video, we're talking about Docusign, ticker symbol DOCU. Year to date, this company's been beaten down 27%. Course of 1 year, it's down 23.8%. So Docusign provides electronic signature software in the United States and internationally. The company provides e-signature solutions that enable business to digitally prepare, sign, act on, and manage agreements. So basically, if you have ever purchased a home, sold a home, do rental properties, you likely have used Docusign because it is a very useful um, e-file or e-signature tool when you submit an offer on a house, or you have a tenant sign a lease, or there's a slew of other things you can use Docusign for. It is a very useful tool to have and use, and saves a lot of time and paper. So we're gonna look at Docusign's financials and see what this company is up to. Revenue, gross profit growing nicely. Our net income is almost above zero, is still negative, but appears to be growing. As we can see over here, it is heading north, which is good. Well, more northeast, right? So our gross margin is continuing to grow nicely. We're sitting just shy of 80% gross margin. Our net margin, we can see, is also trending just like our net income is. So eventually, hopefully soon, this company will be turning a profit on net margin. So it's almost there, but just ever so slightly not quite yet there. Revenue and gross profit year-over-year change. Looking like it's continuing to slow down a little bit, but still a mid 20s grower on this company. So very good. It's got a lot of growth potential ahead of itself. So good to know, especially since we're not quite profitable yet. But if we can still continue to grow at 20%, we'll soon be starting to turn a profit on this company. Return on invested capital is growing and heading in the right direction, which is good. Cash to short-term debt. We have a lot of short-term debt compared to cash. We will take a look at that on the most recent earnings release to see what the short-term debt consists of. Cash to debt over here. Same thing. We have a lot more debt than cash. Not always a bad thing, but always good to know why or what it is. Net income to free cash flow. We have this is one thing I don't like. We have free cash flow of 547 million and we have negative net income, okay? Now, when we look at here, we have net income. Basically, all of our free cash flow, by the looks of it, is coming from stock-based compensation. So basically, you know, the company's not profitable, but their free cash flow they are free cash flow positive because they're diluting you as the shareholder. So you can see our free cash flow is growing, but not in the right reasons, not for the right reasons. So this isn't a good chart to go off of because you're getting diluted. Because you look over here, your share count, look at the dilution is growing. So as a shareholder, you're getting diluted each and every year. Now we're gonna stop right here and take a peek at something. So that stock-based compensation that we can see that is growing very rapidly, currently now at $583 million. Year over year, that's up 100 and what, $70 million roughly, give or take a little bit there. Take a look at this. On DocuSign, the president gets paid $85 million. Of that $85 million is basically almost all of it is stock-based compensation here. $84.5 million is stock-based compensation that is going to the president of the company. Now let's compare that to the most profitable, well-known company in the world, Apple. Tim Cook, he gets paid $99 million a year. His stock-based compensation award is $82 million. So the president at DocuSign is getting paid more in stock-based comp than what Tim Cook does. And Apple produces what, 80, $90 million in a quarter? Something like that, whatever, or billion dollars. 80 to 90 billion dollars in a quarter. DocuSign is doing 2.7 billion dollars in a year. So how does that doesn't quite add up in my book. So a little bit of a red flag in my opinion on that. So we have capital expenditures that are continuing to grow as well. So, you know, there's a few things to keep an eye out on this company. Also, the side note is our SG&A on this company is exploding higher as well. If they're willing to pay their president $85 million in stock-based compensation, it kind of tells me a little bit that this company doesn't know how to control its SG&A overall and how much to pay its employees I think this company is has a lot of fat that could be trimmed off. If it could reduce its SG&A from $1.6 billion down to, I don't know, maybe $1 billion, figure out how they can trim off some of the excess, SG&A costs that they've got going on over there, that would help this company out tremendously. So to me, that is a concern is what this company is paying everybody. Not to say that they don't need all these people, maybe they do, but I can tell you right now, the president of Docusign does not need to be getting paid $84 million per year on a company that only makes $2.7 billion. Not ideal. So let's continue. Let's look at some comps. We have two comps to compare to. We have Adobe and Dropbox. So as we scroll down here, we have operating cash flow, which is higher than our net income. We've kind of already gone over that. We have shares change year over year, positive 3.78%, and return on equity, which we know is currently negative. So a few, this is the biggest one is that I think that's a big, big, big deal on this company. It's not good to see that. So Adobe's kind of throwing off our market cap and revenue charts over here, but we can continue here at the 5-year growth. We can see Docusign sitting 11, 12%, 10% roughly on revenue growth over here. So our EPS higher than our revenue growth, which is usually the case. Gross margin, we have sitting about 79.3% compared to everybody else, sitting pretty equal. This is where things change on Docusign here. Operating margin. And again, these companies are something close. There's not a real great comparison to Docusign. It's kind of, Docusign is, we're comparing a bear to an elephant, I guess you would say, because Docusign's the bear and Adobe's the elephant. Like, I mean, Docusign's so much smaller of an animal compared to what Adobe is. But profit margin, same thing. We know we're a negative profit margin ever so slightly, but trending higher, which is good. But compared to everybody else, not the leader at all. And then we got free cash flow, which we've kind of already gone through. As we can see, our free cash flow is basically all from stock-based compensation, which we'll take a look at that on the most recent earnings release just to double check that. And return on invested capital, not quite positive yet. PE, obviously Docusign currently a negative PE. All right, so let's take a look at the financial statement here. We have our assets. So this company is sitting at about 1.5-ish billion dollars in cash. It's good. So on liabilities here, we have contract liabilities. So these are just prepaid services. So really, we've only got 1 billion of short-term debt. So we subtract 1.2 from 2.23, which is our total current liabilities, which leaves us with about $1 billion in debt. And then really that we have like $1.2 billion in total debt. So if we come back over to our chart real quick and take a look at our debt, if we've got $1.4 billion in cash, we've only got $1.2 billion in total debt. So this company actually has more cash than debt. It just has services to pay out to its customers. So not a big deal at all there. So that's actually a really good thing. So that's one of those things you always want to look deeper into, and that's why we did that right there. So good to know, good to see. And here's the other thing: is we just sales and marketing had shrunk a little bit there, which is good. Research and development shrunk a little bit, but our G&A is just got to calm down over this company. I mean, I can't imagine why this company needs so much general and administrative, unless they're just overpaying people. I don't know, but to me, that's something that's got to get controlled over at this company. So it's something to me that's enough for me to not want to buy this company, honestly. So we have depreciation, amortization that this company is claiming, and we also have stock-based compensation. So basically we had $7.9 million in the last 6 months of net income. Pretty nominal number there. And then we after we do all of our adjustments to our cash flow, cash from operations, we come out positive $444 million. So we added basically $438 million in cash from places, from all these changes from cash being moved within the company. And we can see basically, I mean, a big, big chunk of it here is stock-based compensation. And then you have depreciation, which is also basically, I call it fake money, but basically these two things is is not ideal to have for a free or for positive free cash flow in my book. So not in my what I'm seeing here is not a good positive free cash flow on this company. They are repurchasing stock, so not enough to offset what it's putting out though. So overall, the only thing that really changed my mind on this company or change on this company that we went through is the liabilities, cash to liabilities here. So that is actually a very good position on this company is that they've got more cash than liabilities. So because this company is not positive, we've only got a couple calculators that we can use to judge our price, our fair market value off of. So our P to valuation gives them a negative. Our multiples also a negative. Manual PE though, we do have a multiple here. We have market cap minus cash plus debt divided by cash from operations gives us 4.6 years. So very well valued, fairly well, very undervalued based on the manual PE. Price to book, 5-year average of 55.82. Wow. Price to book currently is 9.86 on this company. PEG ratio sitting at 1.7. PEG forward looking. So fairly valued forward looking on the PEG. Graham's valuation, giving them a negative, they are negative EPS. So we have DCF. This would be one of the calculators that we can use that gives us a price on this company. Currently, we have free cash flow growth rate of 14%. The downside to this is that free cash flow growth rate is mostly stock-based compensation. So this is kind of not a good number to go off of because in my eyes, it's like a fake free cash flow. It's not, I don't think it's sustainable. It's not healthy for the company to be a free cash flow positive company when they are diluting their shareholders like that. Rule 72, I've had to punch in the forward looking numbers, the forward EPS and PE. So this is forward looking, at least in the next 12 months. So we have 3 different growth rate sources. It gives us an average of just shy of 13% growth rate on the EPS. 13 goes into 72 5 times, 5 goes into 10 years, 1.8 times there. So then we get to do double our EPS 1 time and just shy of 2 times, which gives us just shy of, or basically 11 for a forward future EPS. So that gives us a fair value on this company of $71.33. And there's our 30% margin of safety on that particular valuation. Docusign currently trading at about $41 per share. We have a fair market value based on the DCF and Rule 72 because those are our 2 positive calculators that we can use on this company. So that gives us $78.91 per share, 30% margin of safety, $55.23 per share. Analysts have a price target of $63 per share. So you're kind of looking at that ballpark range if you combine the fair market plus analysts divided by 2 and figure out roughly $15 difference. You're talking about $70 per share there if you want to go off of those 2 numbers, which I would probably include honestly, to also include the analyst price target on this company, because if you do that, then that's just another third source that you can kind of use to maybe combine and get a better average and then take a 30% margin of safety off of roughly $70 per share there. So that's what we got on Docusign here for a summary. So, maybe you're looking at about 50-ish dollars per share on this company for a 30% margin of safety, which is telling us that it's currently very undervalued. So good news there. Now let's take a look at the stock charts. See how Docusign is trading. Currently, we're sitting basically at our IPO price here, which is right around 35-ish dollars a share. I got a feeling that analysts have looked through this company and the financials and have seen the excessive stock-based compensation. Everybody, all these analysts, this is what they do every day, and I'm sure they've all seen that how much the president is getting paid. And that probably is a big concern to them, and that is to me as well, and their free cash flow as well. If you look at their free cash flow, it's not a good free cash flow on the company. So, they've got some work to do on this company. I get why it's not trading at a premium right now and why it's at 52-week lows, or well, pretty close to it anyway. So, this one's a tough one. This one's a little bit of a gamble in my book because they could change things around really quickly in the company. Like if they fix their SG&A, if they can eliminate some of that cost and add that back into the net incomes, and then they might actually be a positive free cash flow company if they can take care of that and then stop paying out so much stock-based compensation. Make sure the president can take a president could take a $40 million pay cut, right? You don't who needs to get paid $85 million a year like that for running a company on a company that only does $2.7 billion a year in revenue? I don't know. Kind of sketch, I guess, on that one. But that's it for Docusign. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.